Our sense is that this year overall is going to be good, and you want to buy into dips and into the coronavirus uncertainty. So we wouldn't chase rallies like the last 2 weeks, but rather you want to put the money to work in days like today.
All right, so let's say days like today are happening, and let's say that these losses hold to the closing bell. What exactly would you be putting money to work in?
Well, you've got to have at least a 6 to 12-month time horizon because the coronavirus is going to be around. It's going to get worse. Typically, as quickly as things go down, they do recover once there's clarity, once there's a light at the end of the tunnel. So you want to buy a broad basket of stocks. If you've been looking to get into some of the hot technology companies, companies like Apple and Microsoft and Qualcomm are being marked down significantly. We'd buy on that. If you're looking for companies on a longer-term basis, we think there are a lot of great companies that are still at 12 times earnings. Kellogg is selling at a very good price, very good outlook. They have one of the largest fake meat franchises. Viacom got beaten up brutally last week. It's selling at 5.5 times earnings. So forget the market, forget coronavirus. You're buying a very good company with a good yield at 5.5 times earnings. You're generally going to do well. A little bit of economic-centric company. UPS is going to be under 100 today. If you can buy that there, you're getting a very good yield. The world economy is going to recover, whether it's in 6 or 12 months, and that company is going to be a lot higher.
What's curious right now is we showed earlier in the hour that the biggest pre-market losses for Dow components are in companies like Visa and American Express. That implies something, right? That there's possibly a slowdown happening globally. Payments may slow down, everything else. So is this a V-shaped recovery or a U-shaped recovery or one that lasts a little while longer than that?
We think it's going to be a V-shaped recovery. If you look at quarterly earnings, a lot of companies said that they gave their outlook, they affirmed their outlook, but they said it didn't account for the coronavirus, which would hurt their results. So we think the first quarter is going to be weaker than expected. The key is if there's a light at the end of the tunnel, if the market can see the economy picking up after that, which we think it will, companies are going to get a pass on earnings misses because there are going to be a lot of earnings misses. We do think as quickly as things come down, it's going to recover. You're not going to recover the full loss in GDP in the first and second quarter, but you should recover about half of it.
What exactly is then the place that you would stay away from? We've heard some experts say that these defensive-oriented sectors like utilities and consumer staples are overvalued at this point. Nobody really wants to go into treasuries with 10 years yielding 1.4% or less. Gold prices are above $1,600. What exactly do you do then? What do you stay away from?
So we would shy away from those type of investments because if the crisis does end, they're going to give back. So we would not be putting money into gold today. We would not be buying utilities. In terms of consumer product companies, we do own some, but you want to try to focus on those that are 20 or less times earnings. You wouldn't want to buy a consumer product company simply because of its brand name paying 25 times earnings. You're better off just sitting with cash. Because again, if you have a 12-month time horizon and you can buy a business at 13 or 14 times earnings, you're generally going to do pretty well.
All right, so then let's talk from a portfolio manager standpoint. What exactly would be the news flow that you do not want to see that would make you feel worse about what would happen given the coronavirus outbreak and global developments with the economy?
Well, the two wild cards. Coronavirus, it's going to spread. You're going to see more headlines. You saw it go to Europe this weekend. It might come to the United States in a more significant way. The flip side is hopefully there's going to be some sort of a treatment that's better for it. Once you get that, that's the light at the end of the tunnel. But a spread of coronavirus globally, it's going to affect the economy. Typically, when the market goes down sharply on something like this, it does recover as well. So we think that's going to pass. U.S. politically, you saw Bernie Sanders win in Las Vegas this weekend. We don't think that he ultimately would win the presidency, but if there was a great likelihood of that happening, that would be negative for the market. So we wouldn't invest against that, but you do want to watch it.